We continue with our discussion on Applied Corporate Finance Unit 3, and we extend our overall understanding on the earlier project that we were looking at for future retail, and now take it towards the cash flow view of the project. So we have to return back to our future group project. The cash flow will give another, the cash flow view will give another way to evaluate this, which is the net present value way, or find the present value of all future cash flows, right? There are a few sets of changes or adjustments that we need to there. From accounting adjustments point of view, we have to add back all the non-cash expenses that we have already accounted for. We have to make adjustments for capital expenditure, and we have to make adjustments for the working capital that come in, right? These are three of the key adjustments that need to be done. Now, there are some key points that we have to note and talk about. The first one is depreciation. What do we mean by depreciation? Depreciation is essentially the write-off or wear and tear in each asset's value that we are doing year on year. And it actually gives a tax benefit. It's a cash flow benefit for us. Why? Is because it reduces pre-tax profit. It is not exactly a cash outflow, right? So tax value goes down. So let's say if I have a pre-tax operating profit of 100 and I have a depreciation of 20, I pay tax only on 80, assuming no interest, right? That will be 24. So technically I'm left with 56 plus this 20. This 20 never went out, right? So I'm with 76 here. Now, what that means is essentially I'm left with 76 rupees here. And otherwise, if I had taxed the entire 100, I would have been left with 70 rupees with a 30% tax rate, right? So effectively, this extra 6 that I get is because of depreciation. Now, what is important is to understand is depreciation is straight line or accelerated. In straight line, over 5 years, I will just take 20, 20, 20, 20, and hence my cash would be 76. In accelerated, I could take 40 in the first year. So I get 60. 60 will take a tax of 18, give me 42. To this, I will add back the 40, right? So if I take a depreciation, accelerated depreciation, it will reduce profits because my profits are now 42 instead of 56 earlier, correct? That's because the pre-tax profit has gone down, and hence the total profitability will be lower, but it will increase cash flow since there will be a lower outflow of tax. Tax earlier was 24, remember. So 24 minus 18 is going to be 6. That's why instead of 76, I end up with 82, which is 76 plus 6. That 6 is what we saved on account of lower tax payment, right? So if a company is following accelerated depreciation, a lot of the times it would be cash flow positive for you in the near term. In the long run, it obviously matches itself out because what if you pay lower tax today, you'll have to pay higher tax later on at some point of time, correct? The capex, capital expenditure, could be again divided into two parts. One is called the growth capex, which is in any assets that are going to add future growth to your overall company. And building a factory, building another resource, etc., is all that is going to come under this. The maintenance capex, on the other hand, is essentially the wear and tear you essentially take every year, right? That's basically usually in all our project evaluations the amount of depreciation that is there. Maintenance capex increases with the tenure of the project. Longer the tenure, more the maintenance capex that's going to come. All capital expenditures would mean reduction of cash flow, right? The third adjustment we have to make is for working capital. Increase in working capital, increase in receivables, increase in inventory, etc., will mean more current assets, thus will mean more cash blocked and is cash negative for the business. Remember, we have discussed increase in CA is negative. We have to subtract an increase in CA's current assets, right? That's what we have to kind of take care of. Let's go to our Excel file and try and plug in these numbers. So that's our Excel file. We know that to profits, we have to add depreciation, then we have to subtract capex, and we have to change net working capital, right? So where are the profits? The profits are available here, operating profit after taxes, right? Depreciation is available here. I can take the depreciation values from here, right? Less capex, capital expenditure that we have done. So capex is available as the sum of all these three, right? So I can write sum of these three. And remember, we will ignore the initial 500 crores that was taken here. That's because that's already taken. That's not whether we do anything in the project or we don't, that's gone, right? We will discuss that concept in a moment. Less changes in net working capital. Initially, that's going to be 0. Next year, that's going to be this year minus the previous year, right? That's the value we're going to put in changes in net working capital. That's the value we're going to bring in. Let's extend this further. We have the data points available for the year, right? Okay, so that's available here. Can we calculate the cash flow? That's going to be my profits plus my depreciation minus my capex and minus any changes to net working capital. And we can extend this analysis for the next 10 years, right? That's my cash flows that are available to us at this point of time. So we've calculated the cash flows, and capex is only this capex at this point of time. We also have to add the maintenance capex to this that we have missed out. So we have to add the sum of this plus the maintenance capex that we are doing. That's here, right? So we do this and we kind of extend this in the future, and that gives us the exact values of our cash flows that come in, correct? So that effectively gives us our cash flows for all these years. Now we can extend this analysis in terms of how do we discount it. Remember, the cost of capital we had already calculated as 10.8%. We can go back to our discussion and look at some of the other features that are important. So the first part is treatment of sunk cost. What do we mean by sunk cost? Any expenditure that has already been taken that cannot be recovered, even if the project is rejected, is called a sunk cost. Market research, tracking of market for a consumer product, R&D expenses, these are all good examples, right? Sunk costs should be ignored since they are not incremental to the nature of the project, right? So you can practically ignore all the sunk costs that are there. In our case, we are going to ignore the 500 crore that was initially invested. That's sunk cost. Remember, however, that the depreciation on account of this 500 crore is incremental. So we are going to include that 50 crore every year in the depreciation value because that is available and that gives us an actual tax break every year. Correct? That's an incremental improvement in our profitability every year. So we do use that in terms of our tax shield, but some costs need to be ignored. The other thing is usually when you're looking at cash flows, you use EBIT into 1 minus T, right? You use EBIT into 1 minus T. But in this case, because we do not have an interest, we are basically going to use EBT into 1 minus T, which is nothing but your net profit. That's where we have started from. Otherwise, if there is an interest component, ideally we should start from EBIT into 1 minus T. In our case, that's the same number that we get, right? That's the cash flow view. Note that we have ignored the sunk cost of 500 crore in this calculation. That's a broad cash flow views that we have at this point of time. Let's try and now find the discounted cash flow. So now we have to discount this set of cash flows using the weighted average cost of capital. We're basically solving it for the NPV. We could also use IRR, except if NPV is greater than 0, except if IRR is greater than the hurdle rate. What is the hurdle rate here? That's the weighted average cost of capital, right? There are some more adjustments that we will need to do. Unlike our accounting treatment of this particular project, in this case, we are going to assume that the project continues till infinity. So we will have to deal with the terminal value of the project. Remember, we have already done this, that when you're using discounted cash flow applications and you're looking at terminal value of cash flows, you look at the last year cash flow. So cash flow in year 10, you multiply it with the steady growth rate and you divide by the cost of capital minus the growth rate. This is the value of the cash flow. So if we are doing the evaluation in the 10th year and CF is the cash flow, CF10 is the cash flow here, the value of all cash flows after this till infinity, all cash flows after this till infinity, when discounted back to this 10th year, so if I call this value X, this X is given by this formula, right? So we will have to assume a steady growth rate and we will have to work based on that, correct? So we assume that the project grows at 4% in a steady growth rate. So we have the G as 4%. We have cost of capital as 10.8%. We have the last year cash flow. We can multiply and find out the value of everything till infinity, right? That can be done. And then let's try and calculate all this. Let's go back to the Excel. What we are saying is that here itself, I can put in the terminal value, and that's going to be equal to my last year value. And let's put a growth rate, steady growth rate number. That's 4%. Remember? So 150 multiplied by 1 plus 4% divided by 10.8 minus 4%. That's my long-term terminal value till infinity, right? So now the cash flows to be discounted, we will write them, and these are the cash flows. This plus the down one, I'm just writing plus as well so that the last year cash flows get clearly established. Can I find the present value of all of these, right? I can either do a direct NPV of this, so I can just use the formula NPV and use rate and use all these values, and that will give me the answer, right? Alternatively, I can find the present value of all of these, which is each one of these set of cash flows divided by 1 plus the rate of cost of capital raised to the power the year of discounting, 1 plus r to the power n, right? And I can track all of this till here, and we can do an NPV calculation. That's the sum of all these, which was the same as 729 that we had seen earlier. So 729 crore is the net present value of this project. Remember, if it is greater than 0, we accept the project, right? If it is less than 0, we reject it. What is the IRR of the project? Can I calculate the IRR of this project? All I need to do is select this set of cash flows and try and find out. IRR of this project is 14.11%, which means till the time my cost of capital is less than 14.11%, I will accept the project, correct? If I take this number to 14.11%, right, then essentially that is where the NPV will start kind of moving ahead in terms of our calculations. Automatically, this is obviously a recursive loop here. And the adjustment difference also happens because here, once we change it to 14.11, there is a recursive cyclical loop that comes that changes the terminal value as well. So it's not so easy to directly come up with this because the IRR takes this into calculation and the terminal value changes if I change this formula. But given this set of cash flows, assuming that the final year cash flow is this much, because we have kind of substituted everything else that is coming from future to here, we are getting an IRR of 14.11%, right? So that is where we get our discussion, NPV and IRR. So we accept the project based on this premise, we accept the project based on this premise. Let's go back and revise. Now IRR and NPV will usually yield similar results most of the time, though there are certain differences between both the approaches, and we will look at them as we go along in more detail. These differences can cause project rankings to vary depending upon the approach used. They can yield different results, especially while comparing projects, while comparing across projects. Project at any point of time can have only one NPV, right? But a project can have more than one IRR. We will look at cases where that can happen. The NPV is a dollar or a rupee surplus value essentially. It's a nominal surplus value, right? Whereas IRR is a percentage measure. So NPV is going to be larger for large scale projects. IRR is higher for smaller projects in general, right? IRR favors smaller projects, NPV favors larger projects because on larger projects you'll get a bigger value. The NPV assumes that intermediate cash flows get reinvested at the hurdle rate. IRR assumes that all of them get reinvested at the IRR, right? Which means if I get 10 and 110 and my rate of return is 10%, I'm assuming that this 10 that I get after the first year is reinvested at 10. Only then after the 2 years I get 121, right? That is what is the inherent assumption in IRR or NPV formula, that whatever is the discount rate, we are basically reinvesting the cash flows that are intermediate at the discount rate, right? And in the case of NPV, obviously that discount rate is the hurdle rate. That's where it comes in. We also have to assume the currency impact. The cash flows on a project and the discount rate used should be in same terms, defined in same terms, which is if the cash flows are in dollars, the discount rate has to be in dollars, the dollar discount rate essentially. If the cash flows are in rupees, the discount rate has to be the rupee discount rate essentially, correct? That's something that we have to be very, very clear about. If the cash flows are nominal or real, the discount rate also has to be logically nominal or real in that context, right? That's the broad spectrum of the currency impact that comes. With this, then we finally move to what is called as sensitivity analysis. It is always a good idea to alter the variables such as revenues, costs, discount rates, and look at what happens to the project analysis in real life. Should, in real life, should things change, how does that impact the project analysis? And also tells us what are the key variables. If I change revenue and things change dramatically, then it is important for us to kind of pay enough attention while creating those revenues, right? So it gives us a sense of what is happening in that context. So remember, based on NPV, we are saying that NPV greater than 0. Our NPV calculation gave 729. So accept the project. IRR calculation became 4.11%. That's greater than the 10.8% hurdle rate. So again, accept the project. On both counts, we are saying accept the project. Remember, in our profit analysis, accounting profit analysis, we had rejected the projects. Why? Is because our return on capital that we were getting was less than the hurdle rate. And that's how, when you use profit or when you use cash flows, the analysis differs. It is important to use the cash flow analysis whenever we are analyzing a project. That is where we will get the clearer picture about whether we should accept a project or not accept a project. Correct? So that's a simple project. Obviously, when we do look at the comparison of NPV, IRR and these parameters, and we look at relative comparison of these metrics, it will become clearer when we look at trying and adjusting the data and look at choosing which metric should we use all the time. So this is a scenario where the projects are giving similar data points on both NPV and IRR. In real life, things could be a little bit different, right? Those complications we will introduce in subsequent sections. Some final adjustments that we need to remember about. We can use different discount rates for different projects. In this case, we just use the same discount rate on all the projects. But if we believe that risk is not the same for all the projects, we can find out individual project betas, calculate cost of equity for each of the projects separately, calculate cost of capital for each of the projects separately based on their debt equity ratio individually, and then calculate the individual NPV for each of the project to see that. We can also do an entire analysis on cash flows to equity here. In that case, all we'll have to do is we'll have to just use the cost of equity while discounting instead of cost of capital while discounting, right? Those are some of the final adjustments that we can do. And as we end, a couple of questions. What is the need of sensitivity analysis in project evaluation? And explain how depreciation creates a benefit for the company. Thank you.